Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. We are doing, Rob and I of the Mindfull Investor are doing another podcast for you guys. Today, the topic is options. So, stock options, and we're going to try to give you a little bit of a background, and then each of us has a different way of how we work with options and how we make money off of options. So we're going to go through that and introduce everybody. So here's Rob.
Yep. Hi, Alesh. Thanks for having me again. And I actually deal a lot with options. So if I do my taxes, I think that represents 50% plus of my gains. So yeah.
Nice, very nice. Yeah, I'm a little bit behind there, but I do have a positive cash flow from the options. So we'll try to show everybody what we do and how we do it. But for those who aren't familiar with options, we'll give you a bit of a background, and Rob will fill in anything that I've missed because there's a lot of it. If you're not familiar with options, you should do a little bit of reading because there is a lot to it, and frankly, compared to stocks, options are way more complicated and there's way more things that you can do with it. So in any case, so an option is a contract which is traded just like an asset, and it is basically a right or an obligation, depending whether you bought or sold it, to purchase or sell a stock, a specific stock, at a specific price. That specific price is called the strike price. And these contracts have a given time span. So they will expire after anywhere from a couple of days to a couple of years. And if we're ever talking about the premium, that is the price that you pay for the option or that you sell the option for. It is different than the option strike price. So that's kind of an overview. And you have two flavors. You have puts and calls. But before we go into that, Rob, did I kind of capture the high level of what options are?
Yeah, I think that's like the basis. But then there's one thing to note is that one option contract represents 100 shares. So whatever we do, we need to kind of multiply the share price by 100. So let's say if we sell puts, as Alesh and as we're going to talk about later, we need to be multiplying a lot of things by 100.
Right. That sounds confusing when you listen to it, but in practice, you can really figure it out because they will say contracts, and then you'll say three, and otherwise they'll say shares, and it'll be 300. It's really in practice, it's not that bad. Uh, don't worry, you're not on the hook 100 times more than you thought you were on the hook for. Like that doesn't. At least I didn't really get into that.
Yeah.
Because before you do a trade, your broker will show to you that, like, if you're in the hundreds of thousands of dollars, and you're like, oh, probably not. So let's talk about the first flavor of options, which is puts. And just to be clear, puts and calls are not related to each other. They don't offset each other. They go in opposite directions, but they're totally separate. Okay. So what happens with a put is that the stock price is here, and you will have a put with its strike price here. So that's called out of the money. So for example, you have $100 per share is what the stock is trading at, and there is a put that you can sell or buy that's $80. So the reason you would use a put is if you think that the stock is going to go down and go below the strike price, you would want to be buying the puts. So, and what a put does is it lets you sell your stock at the strike price. So it's sort of, if you're buying puts, you're buying insurance. So with that $100 share, you think it's going to go down to 60, but you don't just want to outright sell it. You just want to buy some insurance, which it will end up being a lot cheaper, but it will have a finite time frame. It'll expire after a while. So you think it's going to go down. So if it goes down and it drops below 80 and it goes down to the 60, you were right. Then you're, with those puts, you're able to sell your shares for $80, even though currently they're worth 60. So you're basically able to limit your risk by buying insurance. So that's why you would buy a put. Now, selling puts is the other way, or writing puts goes the other way. You are thinking the stock is going to go up, and you're thinking that that put is going to expire worthless. So stock price is up here, you sell the put down here, stock price goes up, or it goes down, but maybe not all the way down to the 80, and you're able to collect the premium, which you get right off the bat. You get that immediately, and then the put expires worthless, and you get to pocket that. The other thing though is maybe you like the stock, but you don't like it up here, you like it down here. So you sell the put, you get the premium, you get to collect the price. The stock price goes here, but maybe it goes just a little bit below, and you're able to buy it at this price. So for anybody who's bought on a limit order previously, bought a stock on a limit order, that sort of works that way. The danger is that the stock keeps going down, but for somebody who's a buy and hold person anyway, I wouldn't sell the stock if it kept going down after I bought it. So I'm okay, and I'm always up that premium that I collected. So those are puts. You're thinking, if you're buying them, you're thinking the stock is going down. If you're selling them, you're thinking the stock is going up. So Rob, I'll let you talk about the calls.
Yeah, just to add a little bit to the puts,
Oh,
like
sure.
you mentioned, sometimes you use it as insurance, which is true, which is like a hedge on your position. So let's say if you have position on Coca-Cola and then you just want to buy some puts just in case the stock crashes, then you can profit from the puts while you kind of lose from the stock price of Coca-Cola. You kind of offset that. So that's why they call it a hedge. And then another reason to buy puts is when you're really bearish on the stock. So you think they're overvalued, you think they'll crash like 30%, 40%, that you don't own the stock whatsoever, and you just buy a put. And then normally you buy it, let's say for Apple right now, it's at 130. And then you say you buy a put at 100 even. So normally you get like extra aggressive with it. And then if the Apple actually tanks to like $90, let's say, then your put options would be like 5x. Like that is the home run play that people go for. That's the alpha plays. So that's another reason why people buy puts and buy calls. So same thing for the calls. So buying calls is when you're extra bullish on certain things and you buy things that are out of money, as Alesh says. So let's say the stock price is at 100 right now, and then you buy a call at 130, let's say for 1 year. So you're saying within 1 year, the stock will go up 30% plus. And if it does, then you get the huge multiplier. So that is buying calls. And selling calls, it's there are two flavors. Selling calls, there's a naked version or a covered call version. So naked call, the naked covered call, the naked call version means that you don't own the stock outright, but you're kind of bearish on it. So let's say in the Apple instance, is at 130, you say that over the next year is not going to hit 200. So you sell a call at 200. And if it remains under 200 for the whole year, you collect all the premiums. So whatever you sell that call at, let's say the call contract is at $5, which you have to multiply that by 100. So that $500 would be all yours if it stays under the $200 cap. But if it breaks 200, then your losses could be unlimited. Like that is why it's called naked call. So your losses are not like protected. But for covered calls, so for covered calls, let's say you have to own like 100 shares of the certain stock. Let's say Apple, you own 100 shares and you do the same thing. You sell a call at $200. And if it breaks $200, let's say if it goes to $500, it doesn't matter. You already sold your 100 shares at the $200 mark. And this strategy is great for beginners because it's like a win-win strategy. Because when you sell the premium at $200, you already collected the $5. That's in your pocket. If it stays under the $200, that's all yours and you're still keeping all your shares. But if it breaks through 200, you're capitalizing on the capital gains, which is the 130 to the 200, so $70 times 100 shares per contract, you're $7,000 up. So that is like a win-win strategy. That's one of the best strategies I think beginners should start out with, along with the cash secured puts. So am I missing anything? Yeah, and then on the other side, you can sell calls. That we talked about that. Sell calls, buy calls. We talked about both. Yeah.
Right. So we should maybe preface our discussion with some people will actually hold the stock or want the stock. So they'll use the options in order to get the stock or to get rid of the stock. While quite a few people are making money just by trading the options and they actually want nothing to do with the stock at all.
Yeah.
So for example, with the uncovered calls, the stock price is here. You sell a call up here. If the stock goes past it, the call, if you sold it, is an obligation to provide the stock at this price. Even though the stock price went beyond it, you have to basically shell out cash as if you bought the stock gets bought, and you only get this price. So you don't actually have the stock up front, unlike the covered call where you do have the stock up front, and you bought it for something, but you know what that was. While with the uncovered call, the stock could keep going and going and going, and so theoretically, I mean, it doesn't really happen in practice, but theoretically, your risk is limitless. I'll show you. I actually did a covered call, and I'll show you kind of what my experience was with that. I made some money and then I missed out on some money, so that's how that works. So, and actually going back to your previous point with the buying of puts, I mentioned you can buy them as insurance, but yes, absolutely, you can just buy a put even though you don't have the stock to get rid of, because the put, as the price keeps going down, will gain additional value. So that way, if you're just a trader of options, then you are able to make money that way. So forgive us for bouncing around the puts and calls. To us, it's fairly familiar. If you're just starting out, just keep in mind calls are usually up and puts are down. The stock price is here. Puts you get down here. Calls you get up here. Well, that's, I guess, a good way of remembering it. So now the other thing I was going to mention is that what affects the price of an option. And by the way, the options get traded just like stocks, and so their prices move. But options are also called derivatives because they derive a part of their value from the underlying stock price. And so the price of the option depends on a couple of things. It depends on the current stock price. It depends on what that option's strike price is. We talked about that. I also talked about the limited time. So the time to expire matters. So if you have something that's only a couple of days away, there isn't much value in the option price due to time. But if you have something that's 3 months out, well, there's a lot of time for the stock to move in whichever direction you're hoping for. And so the option price is going to be higher. And then the last thing is the volatility. So if the stock price fluctuates a lot, the option price is likely to be higher. And remember, the stock price volatility can change as well. So the corresponding option price will change as well. So yeah, those are kind of what happens. It's I kind of think of it as calculus when you talk about derivatives. That is actually fairly true because sometimes you're talking about changes in the underlying stock price, and that affects your option price. So yeah, options are derived from the underlying stock price. Well, thank you everybody for joining us. Hopefully you found this podcast useful and entertaining. So thank you, Rob from the Mindfull Investor, for joining us. This has been Alesh Iser from the Canadian Money Talk. Thank you very much.
Thank you.